In the last chapter, we studied pullbacks and continuation. We learned that not every move against the trend is a reversal. Sometimes the market is only pausing before it continues, but sometimes the pullback does not hold. Sometimes structure breaks. Sometimes the market stops defending the old direction. That is where reversal analysis begins. A reversal means the market is changing direction in a meaningful way. It is not just one candle against the trend. It is not just one pullback. A useful reversal shows that the old structure is weakening and new structure may be forming in the opposite direction. That can take time. The goal is not to guess the exact top or bottom. The goal is to recognize when the evidence changes. The easiest comparison is pullback versus reversal. A pullback moves against the trend, but structure still holds. A reversal moves against the trend and starts to damage the structure that made the trend clear. In an uptrend, a normal pullback may hold a higher low. A reversal may break that higher low and fail to recover. This difference is why structure comes first. The first warning is often a change in behavior. A pullback may become deeper than the prior pullbacks. The countertrend candles may become stronger. The trend direction may stop making easy progress. This warning is not enough by itself. It only says the old rhythm may be changing. Beginners should notice the warning, but still wait for more evidence. A structure break is stronger evidence. In an uptrend, price breaks below a higher low that buyers needed to defend. In a downtrend, price breaks above a lower high that sellers needed to defend. The break does not guarantee a full reversal, but it tells you the prior trend has been damaged. Once structure breaks, continuation in the old direction becomes less certain. After a structure break, watch what happens when price tries to continue the old direction again. If an uptrend breaks down and then buyers cannot reclaim the lost area, that is useful information. If a downtrend breaks upward and then sellers cannot push price back down, that is useful information. Failed continuation shows that the old side may be losing control. It helps confirm the shift. A reversal becomes clearer when the highs and lows begin to shift. An uptrend may stop making higher highs. Then it may break a higher low. Then it may form a lower high. A downtrend may stop making lower lows. Then it may break a lower high. Then it may form a higher low. That sequence shows the market changing structure. In an uptrend reversal, buyers first lose the ability to keep making clean progress. Price may sweep a high or fail near supply. Then price breaks a higher low. After that, a rally may form a lower high. If sellers defend that lower high and price moves lower, the reversal has more evidence. The key is the change from higher lows to lower highs. In a downtrend reversal, sellers first lose the ability to keep making clean progress. Price may sweep a low or fail near demand. Then price breaks a lower high. After that, a pullback may form a higher low. If buyers defend that higher low and price moves higher, the reversal has more evidence. The key is the change from lower highs to higher lows. Reversals often connect back to break and retest. After structure breaks, price may return to the broken area. If the old support becomes resistance, that can support a bearish reversal. If the old resistance becomes support, that can support a bullish reversal. The retest is useful because it asks whether the old structure has truly changed roles again. The response matters. Supply and demand can give reversals context. An uptrend may reverse after price reaches a strong supply area and buyers fail to continue. A downtrend may reverse after price reaches a strong demand area and sellers fail to continue. The area alone is not enough, but when an important area combines with structure break and failed continuation, the evidence becomes stronger. Context and structure should work together. Liquidity sweeps can also appear before reversals. Price may sweep above an obvious high, fail to hold, and then break structure lower. Price may sweep below an obvious low, fail to hold, and then break structure higher. The sweep is not the reversal by itself. It is a possible warning that the move beyond the level did not find acceptance. The structure break gives the idea more weight. Candlestick behavior helps you read the transition. Do candles in the old trend direction become weaker? Do candles against the old trend become stronger? Does price reject an important area? Does the close support the new direction? One candle is not enough for a full reversal, but candles can show pressure changing before the larger structure is obvious. A reversal is usually not instant. It often develops in stages. First, there is a warning. Then there may be a structure break. Then there may be a retest. Then new highs and lows may form in the opposite direction. Trying to label the reversal too early can create confusion. Let the stages build. One beginner trap is trying to call every top and bottom. An uptrend can look expensive and still continue. A downtrend can look oversold and still continue. If you call reversal too early, you may fight the trend before evidence changes. The better question is not, is this the exact top? The better question is, has the structure actually shifted? Sometimes a reversal forms after a range. Price may stop trending and begin moving sideways. That range can be a pause before continuation or a base for reversal. The difference comes from the break out of the range and the behavior after it. If price accepts outside the range and creates new structure, the market may be changing direction. Do not assume the range by itself is reversal. Trend exhaustion means the prior direction is losing strength. Impulse legs may get smaller. Pullbacks may get deeper. New highs or new lows may barely extend. This can warn you that pressure is changing, but exhaustion still needs confirmation. A tired trend can keep drifting longer than beginners expect. Structure gives the warning a stronger foundation. A beginner workflow can stay simple. First, identify the current trend. Second, notice any warning signs. Third, wait for structure to break. Fourth, watch the retest or failed continuation. Fifth, look for new structure in the opposite direction. If the process is missing, the reversal idea is weaker. The first mistake is calling reversal from one candle. The second mistake is fighting a trend only because it feels extended. The third mistake is ignoring whether structure has actually broken. The fourth mistake is forcing a reversal story after the move already happened. Reversal analysis needs patience. It is about evidence changing, not about guessing dramatic turns. Here's a simple practice sequence. First, mark the uptrend. Second, watch price fail to make a strong new high. Third, watch price break below the higher low. Fourth, watch the retest form a lower high. Fifth, see whether price creates a new lower low. That gives you reversal evidence in order. Here's the recap. A reversal is a meaningful change in direction. It is not just one candle or one pullback. The first warning is often a change in behavior. A structure break gives stronger evidence. A failed continuation or retest can confirm the shift. New highs and lows in the opposite direction make the reversal clearer. Reversals help you understand when the old direction may be losing control. But reversals often form around liquidity. Price may reach obvious highs, obvious lows, or internal pullback points before the shift becomes clear. In the next chapter, we will organize this idea with ICT liquidity. That will give us cleaner language for external liquidity, internal liquidity, and why price often moves from one area to another.